Microsoft and Alphabet are reporting earnings Wednesday after the close. So, how should you trade these? Is a call option a better idea, or is a put option a better idea? Or maybe just sit these two out. I'm going to explain what could make the stocks go up as well as what can make the stocks go down. But the first thing you have to understand is that if you are expecting these stocks to beat earnings expectations and then fall 10% like Tesla did, you might be mistaken because Microsoft and Alphabet are very different companies from Tesla. The thing about Tesla is Tesla went into earnings with a forward PE of 80. Now, I use forward PE on growth stocks because this already includes the future expected growth. And the S&P 500 right now has an overall forward PE of 18, but the tech stocks are running a little bit higher. They have a forward PE of 22 on average. So for a forward PE of 80, we're talking about a stock that is trading at 4 times fair price. And Tesla was going into earnings at a price of around $280 a share. It was 4 times too expensive, meaning the fair price on Tesla is around $70 a share. And a lot of people don't understand this. They get mad at me when I say this. They're like, what, do you hate Tesla? You think it's horrible? You think EVs are going to fail? You think everybody's going to go back to ICE cars? You idiot. And they don't understand that there's a big difference between a great company and a great stock. Take Tesla cars, for example. Is a Tesla car a great car? Absolutely. If you could buy a Tesla Model S for $40,000, would you do it? Well, most people who are in the market for an EV say yes, absolutely. $40,000 for a Tesla Model S is a good price, and I would pay $40,000 for a Tesla Model S. It's a great car. It has great range. It's fast. It seats the whole family. It looks nice. It's built well. They are incredible and great cars. But now, let's say that somebody wanted to sell their used Tesla Model S to you for $300,000. Would you buy a Tesla Model S for $300,000? Most of you would say, no, absolutely not. That is way too much money for a Tesla Model S. And I might respond, what's your problem? Do you hate Teslas? Do you think they're horrible cars? Do you think they're going to break down? Do you think EVs are going to fail? You think everybody's going back to ICE cars? You see, getting emotional and angry over saying that a car is too much money is just silly. It's ridiculous. The fact is, a Tesla Model S, depending upon features, is worth probably between $40,000 and $60,000, but it's definitely not worth $300,000. Nobody in their right mind would pay $300,000 for a Tesla. Now, just because they're not willing to pay $300,000 for a Tesla doesn't mean they hate Teslas. They're great cars. They're just not worth $300,000. And the same is true for the stock. Tesla's a great company. They're an incredible company. They're changing the world. Their cars are extremely well built. Their deliveries are going up. Everything about Tesla is a great company. But does that mean the stock is worth $280? No, absolutely not. The fair price on Tesla stock is somewhere between $60 and $80. So if buying Tesla for between $60 and $80 is like buying a Tesla Model S at $40,000. Buying Tesla stock at $280 is like buying a Model S at $300,000. Too many people just look at Tesla as a company and they say, oh, it's a great company and I'm willing to buy the stock at any price. And they fail to look at the fundamentals. They fail to look at what the stock is actually worth from a fundamental value. And that is why understanding fundamentals is so important, and why once you understand fundamentals, you can see how Tesla could beat earnings and yet fall 10% after reporting earnings. Now, when it comes to Microsoft, Alphabet, and even Meta, we're in a very different situation. These stocks don't have forward PEs of 80. In fact, they are far closer to fair value. So if one of these stocks is going to beat earnings expectations, it is far more likely to rise. It's not going to have that 10% drop like Tesla did because the valuation isn't already extremely overbought. Remember, I said the average forward PE ratio on tech stocks right now is 22, and Alphabet has a forward PE ratio of 22.87. Meta is pretty close as well with a forward PE ratio of 24. So because Alphabet and Meta are both trading at fair value, meaning their stocks aren't extremely overbought, despite the AI hype, they're still trading at fair value. Because of that, not only are both of these stocks great buys for long-term holds, they don't really have a lot of value as a short-term trade. For a short-term trade, you would prefer to see that forward PE ratio much lower, say around 10 or 15. That would make it a good short-term trade. But at fair value, they're a really good long-term hold. So both Alphabet and Meta are trading at fair value. They're both great long-term holds at the current price. And if either one of these companies is able to beat earnings expectations, I would expect the stock to rise. If either one of these companies misses earnings expectations, I would expect investors to then look at the forward guidance and then rise or fall based upon the forward guidance. So I do believe that Alphabet and Meta are going to perform much more like a normal company when it comes to earnings. Now, whether or not you should buy or sell, well, we've got a couple things going on here, and then we'll talk about Microsoft in a minute. When it comes to Alphabet, it has a lot of good things going for it. Clearly, their cloud computing services are strong. I believe they are profitable, but Alphabet doesn't really have a good working, strong AI model yet. And short term, the biggest concern I have for Alphabet is their advertising revenue. We have seen a number of companies pull back in advertising. Netflix reported they said they were having trouble getting advertisers. So I really don't think that Alphabet's earnings are really going to be that great this quarter, because I do think they're going to struggle gaining advertisers just like so many other companies have. So for that reason, I'm not entirely sure. Now, here's the flip side of that, is that analysts have lowered their expectations of earnings, meaning analysts are going into Q2 earnings already expecting that Alphabet is going to have trouble gaining advertisers, that their advertising revenue is going to be down. They've already priced that in. So will Alphabet beat earnings or not? Well, this one is really a bit of a toss-up. It's really, really hard to say. Earnings aren't expected to be great, but with analysts already expecting them to be pretty bad, can they beat bad expectations? That's the question. And I think there's a good chance they can, but I think it's a bit risky. If you are looking to buy Alphabet for a long-term hold at the current price, I think it's definitely fair valued. But as a short-term trade, I think it's too risky to trade. Now, when it comes to Meta, Meta's in a little bit of a different boat. It's slightly higher on the valuation, not extremely overvalued, but just a little bit above fair value. Meta, I think, has some good things coming forward in the future, such as their AI, the fact they're working with Microsoft to actually monetize their AI. But on the downside, Meta also has a lot of short-term struggles. Meta is dealing with the fallout of their metaverse, which was a complete and total disaster, and the billions and billions of dollars they dumped into that. And one thing that does concern me is that Meta has said they're going to cut back on spending tremendously, meaning no longer really going after trying to develop that metaverse. They did just come out with Threads, and a lot of advertisers said, okay, cool, we'll go advertise on Threads, but the usage on that has not been great. It started out strong, and then it just dropped off a cliff. So we'll have to see how that plays out. I think Meta has some really good things going for it long term in the future, but short term, they still have a lot of struggles. So when it comes to Meta, I don't think the actual earnings are going to matter that much. I think what's really going to be important for Meta is that earnings call and how they are able to hype up the future of the company on the earnings call. I think that is going to be critical for Meta. Now, if Meta is able to do an incredible job hyping up the earnings call, I think the stock will rally. But if they fall short on that in any way whatsoever, we could see a drop even if earnings are good due to the fact that so much value on Meta right now is really on their forward and their future expected earnings growth. So I would say I'm a little bit more bullish on Meta than neutral. I'm not going to play Meta, I'm not going to do anything with it, but if I were, I would probably lean more towards a call than I would a put. Now, let's talk about Microsoft because this one's in a very different boat. Microsoft is going into earnings with a forward PE of 35.69. That is double the average PE in the S&P 500 and much higher than the average tech PE of 22. So when it comes to Microsoft, Microsoft is kind of in the same boat as Tesla. I mean, not nearly as badly, but they're going into earnings overbought or overvalued. And the thing about Microsoft is Microsoft's really been running up a lot lately on AI hope and AI hype and speculation. The thing about it is when you look at the fundamentals of Microsoft show that the actual revenue and the actual profit from AI is expected to be a drop in the bucket. I mean, we're talking about less than 1% of their total revenue and profit. So even if they are able to deliver exceptional results on selling AI commercially, it's not going to make a dent in their profits. So from a fundamental standpoint, Microsoft is absolutely overvalued. I would not be a buyer of this stock. But there is still a lot of AI hype out there. There's still a lot of speculators buying stocks purely on AI hype. And that is the one thing that Microsoft has going for it. The question is, will investors still buy on more AI hype? That's what we don't know. What I would expect is, however Microsoft's earnings come out, they're going to fall way short of the current valuation of the stock. That's pretty much to be expected. Whether Microsoft falls or rises, I think just like Meta, it's all going to come down to that earnings call. If Microsoft can really push the AI hype, and if investors grab a hold of it and find even more reasons to buy Microsoft than they already have, then I think Microsoft can rise after the earnings call. But if Microsoft fails to really push up AI, or if they do and investors just show they're kind of tired of it and they're not hearing anything above and beyond what's already caused them to buy, then I think Microsoft might fall as AI hype starts to fizzle out. So that's my concern with Microsoft. How would I play this, call or put? Well, I think just based upon the fundamentals alone and the fact that Microsoft is quite overvalued currently, and the fact that we've already had 6 months of AI hype, and your typical hype cycle only lasts about 9 months. For those reasons, I would say that I would probably more likely be a put buyer than a call buyer when it comes to Microsoft. Now, that is the individual companies. There are some macro effects that we have to understand as well. The Dow rose another 200 points on Monday, extending the rally to 11 days in a row for the longest winning streak in 6 years. At the same time, the Dow has seen an 11-day rally. The NASDAQ has fizzled out and even gone down. There is a fundamental shift occurring where money is moving out of the mega cap tech stocks and into the rest of the stock market. This is why we're seeing the Russell, the Dow, the S&P go up while the NASDAQ goes down. There is a sector rotation happening right now where money's moving out of mega caps and into everything else, especially Dow components. Now, the fact that that's happening is automatically putting downward pressure on the mega cap tech stocks, which means from a macro standpoint, the mega cap tech stocks are more likely to go down after earnings than go up. So that's just one thing you have to understand that's going to make it a little bit difficult for these stocks to rise after earnings and make it a little bit more likely that they go down instead of up. Now, there are some other macro things that you have to understand as well. And that is the fact that there's a Federal Reserve meeting this week, and on Wednesday, the Fed is going to announce their next rate hike. Now, the market's pricing in a 99% chance that the Fed is going to raise rates by a quarter percentage point. But it's what happens after this meeting that's the big unknown. And that's where we're really going to have to listen to Jerome Powell's speech. Now, currently, expectations are for the Fed to pause at the next meeting and then raise one more time. That may or may not happen. Earlier, Jerome Powell was extremely hawkish, and then after CPI came in a little bit lower than expected, he got a little bit more dovish. So if they kind of come out and they say, we're pretty much planning on pausing in the next meeting, and then we'll play it by ear and just see how the data works from there, that's kind of what the market's expecting. I think we see a fairly flat trade based upon that. But if he comes out and he's more hawkish than expected, say he comes out and he says, core CPI, it's still well above 4%. Core inflation is well above our target of 2%. We're going to have to keep raising interest rates to get this down, and we're probably going to raise rates again at the next meeting. Well, the market's not going to like that, and that could send the market crashing. But if Jerome Powell does the opposite and he comes out and he says, inflation's coming down, we're finally seeing some meaningful progress. We understand there's delays to our monetary policy. So at this point, we're just going to stop raising rates and just see how things work out. Then I would expect the stock market to rally, because stock market's not really expecting that either. So this is another thing come Wednesday that we're going to have to keep our eyes on. Now, most likely, the Fed meeting is going to come out as expected, and earnings are going to overshadow the Fed. But you should be aware that there is a Fed meeting this week in case you see some funny movements, especially Wednesday between about 2 p.m. and 4 p.m. before Meta reports earnings. All right, the last thing I want to talk about is when it comes to playing earnings. Earnings are extremely difficult to play options on. The fact is that when you trade options, there's something called implied volatility. Implied volatility basically means as there is an expected large move in a stock price, the cost of that option becomes more and more expensive. Meaning, as you approach earnings, options become very, very expensive because everybody expects stocks to have these major price movements after earnings. And because of that, it's very, very difficult to make money by just buying a call or buying a put going into earnings. In fact, most people who buy calls or puts are going to lose money trying to play earnings this way. It's not the right way to play earnings. The correct way to play earnings is to do the opposite. Instead of buying the options, you sell them. Now, if you own a stock, let's say you own Alphabet stock, for example, you might sell a covered call. Let's say you don't own Alphabet stock, but you want to buy it, you might sell a cash secured put. That's the easiest way. There's also other ways, which I will most likely be doing, which are with multi-leg options. Multi-leg options says, I'm looking at Meta, for example. I think Meta has a good chance of going up. Therefore, I'm going to do what's called a credit put spread on Meta. Credit put spread makes money if Meta goes up a lot, if it goes up a little, if it trades flat. Heck, a credit put spread even makes money if Meta goes down a little. When you sell options going into earnings, you have a far better chance of making money. If 80% of people who buy options lose money, then 80% of people who sell options make money. And that is why selling options is the far better way to make money when it comes to earnings. Same thing with Microsoft. If I think Microsoft has a good chance of going down after earnings, I'm not going to buy a put option. I'm going to sell a credit call spread. Credit call spreads make money if Microsoft goes down a lot, goes down a little. Heck, I'll even make money if Microsoft goes up a little. That's the beautiful thing about doing spreads instead of buying calls or puts. Now, if you don't know how to do spreads, if you've never even heard of this before, I encourage you to come join my coaching program. I'll teach you how to do it. Gregory R. joined the coaching program and he made more money today than he makes in his 9-to-5 job. If you want to learn how to sell these multi-leg options so that you can make money no matter which way these stocks go after earnings, I encourage you to come join us in the coaching program where I will teach you how to do this. If you want more information on the coaching program, schedule a call with my onboarding specialist who can explain the whole program to you. All you have to do to schedule that call is click the Start Learning button at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video on your social media pages so that others will know what to expect for earnings as well. And don't forget to hit the like button and subscribe. And if you missed last week's video where I explained why Tesla dropped after earnings, make sure you watch the last video that I uploaded here.